Sorkin now, Squawk Box co-anchor. Andrew, the informal definition or technical definition of a recession is 6 straight months of negative growth. We've already had that this year, but today's positive GDP data mean we've avoided an economic slowdown, or is this just a brief blip before things might take a turn again?
I think we don't really know. The truth is it may very well be a blip. This has been a bit of a technical issue in terms of, is it a recession, is it not a recession, semantics, given in large part we have this unemployment picture that just looks so different than what we've had normally, which is if you were going to have so many quarters of negative growth, at the same time you would have also had higher unemployment. So I think still hard to say, but I do think, having just been on the phone with CEOs all day today, that the idea that there's going to be higher unemployment in the future is almost guaranteed.
Is that, Andrew, because executives are trying to be more cautious about what could come, or are they telling they already feel that slowdown afoot?
Well, I think you're seeing it already in many respects. The advertising piece we saw with Meta just yesterday, what you saw with Apple today, to some degree what you saw with Amazon today as well in terms of those earnings, I think it's starting to pinch. I think people are starting to see the early signs of that and are hoping to get ahead of it. And so when I say that there's a likelihood that we're going to see unemployment move higher, which oddly enough is what the Federal Reserve has wanted all along, in terms of trying to help bring down some of that inflation and the wage inflation issue, I think that you're going to start to see that in the next couple months.
And Fed officials, of course, meet next week. Does this strong GDP print mean that they're going to keep their foot on the gas and keep raising interest rates?
I think every Fed watcher that we've been talking to suggests that the foot is staying right there on the gas. I don't think this changes anything. If anything, it may give them a little bit more leeway to feel that they can. Of course, it's not really what happens next week. It's what happens later in the year, and then, of course, what happens in 23. And if you really look at how the market's already starting to think about that, I think there's an expectation that they may overshoot, and then they may have to let up on the gas. We'll see.
Certainly, there are a lot of Fed watchers trying to figure out when that pivot could come, what it might look like. Finally, Andrew, you mentioned the tech stocks and the tech companies that reported earnings. They are just getting crushed in the market. I know we're going to talk about that a little later. But is that an indicator of sorts about the broader economy and any sort of a tea leaf for a recession?
Unclear, because the flip side is you look at some of the big Dow components and they have done remarkably well. It really is a tale of two cities. The growth companies are the ones that have struggled, some supported by advertising, which could be that early signal that there are problems that may trickle over to other parts of the economy. But part of the other issue is just fundamentally that what we've seen is a multiple compression come down. And so many of these stocks that had been growing so fast and so wildly, people are now trying to readjust and say, well, what's realistic for their growth prospects in the future?
What goes up must come down. Andrew Sorkin, we appreciate
Hopefully
you staying
not
up
always,
late for us.
but yes.
Andrew.